Okay, let's talk about sales returns and allowances. Here, we, the company, are selling items to our customers, and then if they're not happy with it, they return the item or we give them an allowance for it. Just like the treatment for sales discounts, the treatment for sales returns and allowances are a little different from the way we treat purchase returns and allowances and purchase discounts. So follow along with this example, and I'll show you how you treat sales returns and allowances. Same example, on May 1st, Elmer's Glue Inc. sold $5,000 of glue on credit. The cost of the glue was $3,000. The terms were 2, 10, and 45. On May 3rd, the customer returned $1,000 of merchandise. The cost of the merchandise returned was $600. And then on May 11th, the customer, paid the amount due. So let's take a look at how we would record these transactions. First of all, let's take a look at the sales transaction. On May 1st, we know that when we sell on credit, we're going to debit accounts receivable and credit sales revenue for $5,000. Remember, that's the first transaction. Next, we also need to record the cost of goods sold, which is $3,000. So we are going to debit cost of goods sold for $3,000 and credit our inventory. That's when our inventory reduced by $3,000 and it became cost of goods sold. So debit cost of goods sold $3,000, credit inventory $3,000. We've taken a look at this twice before, so you should be familiar with this particular journal entry. Now, let's take a look at the transaction on May 3rd. The customer returned $1,000 of merchandise, and the cost of the merchandise returned was $600. Just like a sales transaction, a return transaction also has to have two journal entries. One, to show that the customer returned $1,000 worth of merchandise, and the second part, that $600 of inventory was returned back to us. So we're going to record both those transactions. When we are recording the return of the $1,000 of merchandise, we know that accounts receivable will get reduced by $1,000. Accounts receivable decreases by $1,000 so that the customer will only owe us $4,000. Now, our sales revenue will also decrease, but we do not touch the sales revenue account. We have a separate account called sales returns and allowances, and we will go ahead and debit $1,000 to that particular account. So on May 3rd, we're going to debit sales returns and allowances $1,000, and we're going to credit accounts receivable for $1,000 to take account of the fact that the customer returned $1,000 of merchandise. Again, we do not touch the sales revenue account. We do not debit the sales revenue account. Instead, we have another account called sales returns and allowances. As you may have already guessed by now, sales returns and allowances is a contra revenue account, which means that the normal balance of sales returns and allowance account is a debit. Remember, the sales revenue, the normal balance is a credit, and a contra revenue will have the opposite balance. So the opposite of sales revenue would be a normal debit balance for this account. Next, let's go ahead and record the $600 of inventory coming back to the company. So if we're getting $600 of inventory, you know that our inventory is going to increase, and we show increase in inventory by debiting the inventory account. Remember, inventory is an asset. When an asset increases, we debit the asset. So inventory is going to be debited for $600, and then we're going to reduce our cost of goods sold by $600. Again, our cost of goods sold reduced by $600, and our inventory increased by $600. So we're going to debit inventory and credit cost of goods sold. That takes care of the transaction on May 3rd. Now, on May 11th, the customer paid the amount due. We know that the customer is still within the discount period. Remember, 2, 10, and 45, that was our terms. And our discount period, as long as the customer pays on or before the 11th of May, they're still within the discount period. So let's figure out how much is the discount. Remember, the discount is the 5,000 minus $1,000. So the amount of the discount is $5,000 minus the $1,000 return multiplied by the 2%, which is $80. Next, let's calculate how much the customer will pay us. The customer will pay us the $4,000 that they owe minus the $80 discount, or $3,920, $39.20. Now let's go ahead and record that transaction. We know that $39.20 is going to be paid to us in cash, so cash is going to increase, so as a result we're going to debit cash. We're going to debit cash $39.20. You know that after the $39.20 is paid, the customer is not going to owe us anything. So we need to bring down the accounts receivable balance to zero. To do that, we're going to credit $4,000. So we've debited cash $39.20, credited accounts receivable $4,000. We're short $80, which is our discount. Remember, discounts go into a separate account called sales discounts, and that account is going to get debited for $80. If you remember, sales discount is also a contra revenue account. Finally, let's take a look at where each of these accounts will be reported in the financial statements. You know, sales revenue will be reported in the income statement. Cost of goods sold will also be in the income statement. Sales returns and allowances will be in the income statement, and you're going to subtract sales return and allowances from sales revenue to show your net sales. Same thing for sales discounts. Sales discounts are going to be in the income statement, and again it is subtracted from sales revenue to show your net sales. So net sales in your income statement is equal to sales revenue minus sales returns and allowances minus sales discounts. Next, we're going to take a look at the other three, accounts receivable, inventory, and cash, and you know that all those three are balance sheet items.